It has been a busy week in markets, dominated on many days by Trump's tariff threats. Let's bring in Sam Stovall, Chief Investment Strategist at CFRA Research. Sam, great to see you. Before we get going, despite all the fear and hand-wringing over the tariffs, U.S. stocks hitting a record high today. Interesting that we'd see that reaction.
Well, absolutely, Andrew. It just seems as if the market is dismissing all of this tariff talk as being more rhetoric than reality, and as a result, they're waiting to see, what earnings are likely to do and focus on the fundamentals.
Let's get into you're a great guy for crunching numbers. We love having you on. Give us a summary of the earnings season so far. I know it's not over. We still got some big names, including Walmart ahead. But what has been the pattern so far?
Well, the pattern has been, in many ways, sort of a reminder that management does an excellent job of managing expectations. And when you actually look at what's been happening in this final quarter of 2024, 9 of the 11 sectors in the S&P 500 have experienced upward revisions. And we have had about a 650 basis point improvement in year-on-year earnings increases. So this will make it the 61st out of the last 63 quarters in which actual results have exceeded end of quarter estimates. My only concern is that it has been borrowing from Q1 2025 estimates.
Why would that be?
Well, I think it's because of the tariff talk early on in the reporting period, or I should say even before the fourth quarter had ended, that many companies probably were accelerating their orders to get them in ahead of the tariffs themselves. And so as a result, that's why we're likely to see a very strong Q4 GDP number here in the States. And we're seeing much better than expected Q4 earnings. Yet Q1 2025 estimates were 11.5% according to S&P Capital IQ, but now at 7.8. So basically 300 basis point or a 400 basis point decline rather than the advance that we saw in Q4.
You reckon the S&P 500 is not that cheap?
That is correct. If you look at the PE on forward 12-month earnings, right now around 23 times, it's trading at a 20% premium over the last 10-year period and a 38% premium over the last 20-year period. So I think that while it's elevated, it's not at an extreme if you do a scatter diagram of the PE as compared with the 10-year yield, but it certainly is on the upper end. So I don't think investors should be expecting any PE multiple expansion to drive share prices in 2025, but rather the expectation that we will see about a 10% improvement in earnings for 2025. And right now, forecasts are calling for a 14.5% gain in earnings in 2026.
Just explain that to me. I think you said that the S&P's multiple is 38% above its level over many years. Does that mean the PE ratio is almost 40% higher?
What it means right now, that the PE ratio stands at about 23 times forward 12-month estimates. The average over the last 10 years has been a 19 multiple, and the average over the last 20 years has been more like a 17 multiple. So we're trading at a 20% premium currently to the 10-year average and a 38% premium to the 20-year average.
They're fascinating times. We did see bond yields edging up this week. Is that generally bad, higher bond yields for stock valuations, in the sense that it increases the borrowing costs for companies?
Yes, and I think you just gave one of the reasons why, because the higher the Treasury yield, the lower the intrinsic value when interest rates are applied to an intrinsic value calculation. Plus, it's just the attractiveness of bonds themselves over stocks. If investors can get a higher return from bonds than they would through, let's say, the dividend yield, which is about 1.5% for the S&P 500, if the bonds offer a more attractive dividend yield, then from a substitution aspect, investors might be increasingly moving toward bonds.
You guys have been giving the nod to some Canadian stocks lately. CAE, obviously, they're in the news. Browning West, the LA-based investment manager, pushes for changes. They've won a seat on the board. Tell us why your team are positive on CAE.
Well, we recently added them to our coverage. We now cover 58 stocks that are incorporated in Canada. And our analyst thesis is the market share leadership and what we regard as the moat in the civil business, as well as the potential to expand its asset base and margins in the defense side of the equation.
That's interesting. And of course, now we have this potential governance lift for the company. Barrick Gold. Now, Barrick Gold has been an underperformer over the past few years versus other gold stocks, but you guys see potential.
Yes, we think that we're going to see a positive outlook on the price of copper and gold and the company's relative valuation. It's trading at a 20% discount to its peers on enterprise value to EBITDA. And so we expect the company...
Sorry, go ahead.
Basically, we expect the company to unlock a lot of value in its vast portfolio of assets. They are going to focus on their higher quality mines, in our opinion, which should be accretive to both free cash flow per share.
And then finally, Suncor. Suncor's had quite a run under the new manager, the new CEO, Rich Kruger, and you just upgraded the stock to buy from hold.
That's correct. While the threat of U.S. tariffs on Canadian oil is certainly an overhang in the space, we think that Suncor has less exposure than many, as much of the production is sent to its own refineries or to the Canadian West Coast for exports. Plus, it yields 4%.
Thank you very much, Sam. Really appreciate it.
My pleasure, Andrew.
Sam Stovall, Chief Investment